Hello. So why don't we go ahead and get started? And I'm going to introduce our speaker today, and that is Bill Enright. And Bill is from GMG Savings, and he has over 15 years in technical sales management, and he has a role as a national director at GMG Savings. And my name is Jerry Frank, and I'm the co-founder and CEO of STRATAFOLIO. STRATAFOLIO is a cloud-based software solution that provides financial analytics to people who own, manage, and lease commercial real estate. And using STRATAFOLIO, companies can easily access their financial data through interactive dashboards and share it with their lenders and investors. Our real-time performance indicators help our customers become more efficient and improve their bottom line. One last thing before we get started, if you stay to the end and hear our special offer, it's only available to webinar attendees. Okay, Bill, I'm going to hand this over to you and we will get started.
All right, thank you, Jerry. I appreciate the introduction. I'm very excited to be here today and I appreciate the invite. And today, like Jerry said, we're going to talk about cost segregation. So today we're going to talk about engineering-based cost segregation. There's a few ways that you can do cost segregation. The number one way that the IRS prefers that it is done is an engineering-based, and that's what we do here. We've been doing cost segregation for, I don't know, probably 15 years now, going on 16 years. We've done thousands and thousands of cost segregation studies and helped, just thousands of clients save up in the billions of dollars. So today, let's talk about how we've done that, excuse me, and how you can take advantage of cost segregation. So let's talk about what cost segregation is. And this is a pretty simple presentation that I'm going to do today. If there's any questions, please feel free to let us know and I'll answer them as we go along. But cost segregation it's an in-depth analysis of the commercial property incentive for commercial property owners. We talk a little bit about who qualifies for this. Anybody who has purchased, renovated, or constructed a commercial property within the last 20 years. A lot of misconceptions about cost segregation is that you have to do it when you first purchase or construct a building, and that's not true. We can go back 20 years and get a benefit for you in tax savings. On average, we talk a little bit about how much you can get as a tax savings. And basically, it's about $75,000 for every $1 million in purchase price or construction cost. And when we talk about the tax savings, that's actual tax savings. We're not talking about moving depreciation and that would be your depreciation movement. It would be your actual tax savings. So if you had a $75,000 taxable liability and you had $1 million in purchase price for a building, then we would be able to offset that taxable liability and keep that money in your pocket. So basically, what is cost segregation? So what we do is we take the building that you have bought, constructed, renovated. It can be a leased building that you did, leasehold improvements, whatever the case may be. But what we do is we go through and we break out the different types of components of that building, and we put them into their correct, we call them buckets, 5, 7, or 15-year depreciation. Or, and we'll move them from 39-year or 27.5-year, depending on what type of building it is. So what we're doing is we're reclassifying some of those items as personal property, and we're going to depreciate them over a shorter amount of time. Just to give you an idea what can be reclassified, Site improvements, landscaping, the parking lot. Talk about light fixtures, certain types of wiring, certain types of plumbing, different flooring. For instance, carpet is not a 39-year depreciation. If anybody has carpet and you've lived in the same place for a long time, you know that carpet does not last 39 years. Millwork, there's some electrical, partition walls, cabinetry, furnishings, that kind of stuff. Now, the reason why we can do this is, and they usually don't go through the legal portion of it, but the Hospital Corporation of America went against the IRS and said, hey, you know, there's certain structural components versus non-structural components in buildings that need to be classified differently. And it opened the door for all of the new case law that we have today, or what we call cost segregation today. So basically, they challenged the 39-year rule, went through and, you know, proved that the stuff doesn't last, not everything lasts 39 years in a building, and we're able to go through and get the laws changed. And that way, today, you can take advantage of the tax savings. Again, I talked a little bit about the different types of cost segregation approaches. Most CPA firms or accounting firms use 2 through 5, which is you know, the rule of thumb approach. A lot of them will put it all into 39-year. One of the biggest ones that we see is taking the whole cost and putting it into 39-year. So that way you're getting 1/39 of your investment back each year. The way that we do it is the detailed engineering approach. We use our engineers, and they will break out the certain components that can be reclassified. And as you can see, according to the IRS's Audit and Technique Guide, this is the way that they prefer it. It's the #1 way that they prefer it. Why do we do this? Well, first of all, it's going to increase cash flow for you. It's going to minimize your taxes. There's a catch-up benefit with no amending returns, which all that means is if your building's 20 years old, or let's say 10 years old, we're able to go back and we're able to do the catch-up benefit, and you know, the stuff that we're going to write off in 5 and 7 years, and it's going to be able to be written off today as if it just happened.
Bill, can we go back just 2 slides? Yep. We had a question on what is involved in doing that detailed engineering approach.
Well, one of the things that we pride ourselves on here is doing the heavy lifting. We're a very tech-heavy company as well. We have our own programmers and designers here that we employ in the building. And we've designed systems and programs that are able to make this very easy for the commercial property owner. So the first thing that we want to look at is we're going to start off by looking at a depreciation schedule. And the depreciation schedule that we're looking for is not the tax form, but it's the Excel spreadsheet document. It looks like an Excel spreadsheet, and it'll say building. It tells us when it's been put into service. It tells when or how long it's being depreciated. Like I said, most items or most buildings will say 39-year, and then it's going to tell us if that accountant or CPA has broken anything out of that building. And then after that, what we'll do is we put together what we call a feasibility report. And that's going to be a really good estimate of what your benefit's going to be, what your depreciation is going to look like, and what your tax savings is going to look like. So, and we custom tailor them to the types of buildings and properties. Once that's done, once we get the feasibility together and it looks like a good opportunity, then what we'll do is we'll move forward on the project if that's what the commercial property owner wants to do. Excuse me. And then our engineers will reach out, collect a few documents, depending on what documents are available. Like if there's electronic blueprints, we'll ask for those. We have a secure uplink load or upload link, sorry, that they can upload those information to. We'll ask for a few pictures of the building, and you know, if you have any like property tax statements or anything like that, recent ones, and that's about it. And depending on what's available is you know, what we'll take. So it's very simple, it's very easy. It takes about we run on about a 10 to 15 day I guess cycle. Hopefully that answered the question. I don't know if I went too long on that answer.
Yep, that's good. Thank you.
All right, great. So a few questions that we usually get. And I always like to go through these because a lot of times we'll get these questions and I just like to get them answered. So one of the first questions is that we do is, why don't our CPAs do this already? Well, if anybody knows about the last two tax law changes that went into effect by our last two presidents, you know, there's a lot involved in it. And there's a lot going on with taxes and tax laws. They're constantly changing. CPAs are more focused on keeping up on those laws than they are the specialized incentives like cost segregation or some of the other stuff that we do. So again, CPAs, they're tax return specialists, not engineers. We use engineers to do this. Excuse me. Do you have to amend tax returns? No. When we do the cost segregation, we'll be able to, your CPA will be able to do what we call a 3115 automatic change in accounting, and that will bring all of that depreciation forward as if it happened today. Does this trigger an audit? According to the IRS, this does not. You're filing an automatic change in accounting, which is approved by the IRS. What if you get audited? We provide 100% audit defense of everything that we do. We've never seen a cost segregation trigger an audit, but we have seen in a general audit, excuse me, a cost segregation have questions asked about it. And just so you know, we've had 0 disallowances and 0 shrinkbacks. So that means every audit that we have ever been to in 15 years is our findings have stood up to all questions. The final deliverable for a cost segregation is you'll get about a 45-page engineering report. It's going to have the executive summary of all the findings. We follow all of the case law, so it's going to cite the case law in there as to why we moved which items into the shorter lives. They'll have the audit defense certificate in there, so if there's ever a question, they would just get a hold of us and we would take over from there. It's going to have all of the new CSI breakouts of the assets, the property descriptions, all the final tables and calculations. Like I said, we're going to ask for a few pictures, so it'll have the pictures of the facility that is built into the report, and then all of the new property breakdowns. And a lot of this is just nobody probably cares because it's all technical details that, you know, only the IRS would care about. But it has everything in it that is going to be needed to withstand, you know, any scrutiny. Just to give some examples of some of the savings that we have done, and these are some older case studies we've done, like I said, thousands, but 3 million in grocery store, 630,000 in a Comfort Suites, Holiday Inn, 950,000. And, you know, even my favorite, we did a gas station convenience store and they ended up with about $73,000. So what's the process? Again, I kind of walked through that. We've changed our process a little bit since these slides, but basically the first thing we do is we want to have a conversation with you. We want to find out what type of building you have, how long have you've owned it, have you done any renovations? We're going to look at that depreciation schedule. We're going to, you know, put together a feasibility. We're going to decide, you know, what documents we need, how much the benefit's going to be, and then how much the fee is. These are per project fees. I know that one of the questions that we got were, what should a fee look like? They're all over the board. The way that we do our fees is our agreements, our contracts say that our fees are not going to exceed 10% of the benefit. So basically, you know, if you're going to get $100,000 in savings, you know, we're not going to charge you more than $10,000 to do the project. Now, I'm not saying that our fees are 10%, because once you get into larger projects where, you know, we've done, you know, $1 million in savings, we're not going to charge, you know, $100,000 or more in fees. Any questions? I'm ready to take questions. That's basically cost segregation in a nutshell. I'm going to jump this back over to you, Jerry.
Okay.
And just, you know, so everybody knows, and we can go through questions if there's any questions, but cost segregation is very simple and easy. It's, you know, it's a strategy that the IRS says, you know, if you go through any of their websites or any of the things that they have talked about in cost segregation, you know, they say in there that every building owner, commercial property owner should be taking advantage of this. Any questions?
The first question is about what kind of impact did the last tax change have on cost segregation? The one that happened at the end of 17.
Yeah, well, there's a couple of things that happened. And basically, first of all, the first thing that happened was there were a lot of deductions, business deductions and personal deductions, that got taken away in the last tax law change. And cost segregation was one of them that stuck. So this is one of the only tax deductions that you're still able to get, but it really didn't affect us. It actually made it more, I don't want to say profitable for the clients, but it made it a better benefit because of the fact that, first of all, it's one of the only deductions that got left in, and they instituted 100% bonus depreciation on certain areas, so you're able to write a lot more off. On the other side, you know, they change the way that they change the tax laws. There's let's see, even though your taxes might be, or your effective tax rate might be lower, again, your deductions are lower. So this actually has made cost segregation a very great opportunity for commercial property owners.
Okay. When people do a cost segregation study, do you ever get discounts for doing multiple properties at the same time?
Absolutely.
So
We do multiple property discounts. I even have clients that are return clients, like every single year they do a couple buildings with me, and we, you know, have a set price for them every year.
and they come back for different buildings?
Yep.
Or so
Well, I have a client. I have a client that has multiple buildings, and every building, or every year, he will do, say, depending on his taxable liability, we'll figure out how much we need in deductions, and he'll say, okay, let's do these 2 buildings. And then next year he'll come back. He just did a huge renovation to one of the buildings we already did. So we did the renovations this year. So.
okay. And then how long does it actually take to complete one of these engineering studies?
We're about on a 15-day turnaround.
Okay.
Of course, in tax season, we turn them around quicker. It's all about, you know, making the deadlines. So.
And can you still get the incentive for last year?
We're doing 2018 right now.
Okay.
If that's what you mean.
Yes. Yep.
Yep. Yes, we're working in 2018 tax season.
Okay. Now we have a question. Which process do you find that most local and regional CPAs are using in terms of this?
Most are using the 39-year depreciation, and the reason is they don't want to get too far into the weeds with their knowledge, to where when we do the engineering study, you know, we're able to pull out, well, the different items that I mentioned, but we're able to get that $75,000 or more per million of cost because of that report.
Okay.
Or the study.
If you're getting ready to sell a property, what do you recommend people do in terms of cost segregation?
I'm sorry, say that one more time.
Yeah, if you're considering that you're planning to sell a property in the next year to 3 years, do you recommend doing a cost segregation study?
I don't. My personal feeling is I don't recommend if they're going to sell within 24 months. But I have worked with CPAs that, you know, because of capital gains and the benefit outweighed, you know, what they'd have to recapture. It benefited the clients, you know, to do the cost seg, and they were selling it that year. So we that's the other thing, is we work with the CPAs to make sure that this is a good tax strategy for the client.
Okay.
So as a rule of thumb, we don't recommend doing a cost segregation if you're going to sell it within 24 months of doing the cost segregation. Now, again, we've had CPAs that have, once we turn over the numbers and say this is what it's going to look like, you know, they've said, yeah, this is definitely going to, you know, outweigh, you know, what we're going to lose. So, and they've done it.
What happens then if you have you do end up selling the property and you have gotten extra depreciation? What happens in that scenario?
Well, there's some, and it's very complicated to get into, but there's some recapture that can be done, but it depends on how old the building is as well, and how much depreciation you've already taken. So for instance, if your building's 10 years old and you're taking 5-year depreciation, well, 5 years is already up and accounted for.
Okay. All right. Any other questions from the group?
Well, this one says, did we miss this one? It says If I have a $75,000 federal tax liability and you find a $50,000 cost seg benefit, now I only need to pay $25,000 as a rule of thumb. Yes, that's
Nice. Very
yeah.
nice.
The other thing that we also didn't discuss is the fact that if you can't utilize all of it as well, then it will roll forward for up to 20 years as a carry forward. So if I have $100,000 in cost seg benefit and I have a $50,000 liability, then the other $50,000 is going to roll forward until it's utilized, up to 20 years.
Okay. All right. I don't think we have other questions. So thank you everyone for the questions that you have submitted, and thank you Bill and team for being here today. So thank you for joining us, and as you leave, you're going to be prompted to take a survey, and we would really appreciate it if you would just take a couple of minutes and share your feedback. Thanks again very much. Take care.
Thank you, everyone.